Welcome to the abbreviated version of the daily video update. This is being prepared after Friday's session, July 29th, where we'll look at the action in the market today and then briefly look to see how things stand for Monday, August 1st. And what you see in front of you is the intraday chart, and it ended up being another positive day. We were up. It looks like our scenarios are kicking into gear and they are all pretty much pointing higher at this point. All of our charts are starting to look much more positive. And in fact, even on a short term as well as slightly intermediate term, we're starting to look even a little bit more toppy than we were. So if we see some sideways action to even a little bit declining action, that would not necessarily be a surprise. The one thing that we will watch is if we do see some selling, we'll want to watch the intensity of that. Is there an increase in volume? Does there seem to be real conviction behind it? The market's dealing with a lot of headwinds, but because of what we've been seeing over the last month or so, we continue to see that rotation from value back into growth. That took a while to develop, and now we're starting to see that follow through with price increase. Now, for those of you that have been watching these videos for a while, you'll know that when we're going down, I tend to focus on, okay, what are the positive things? What could help the market go up? Well, when we start going up, now I kind of look more towards what could make us go down from here. That's just a mindset that I have. So it doesn't mean that I'm a doom and gloomer or a perma optimist or anything like that. I just don't want to get caught off guard. And so when we're going up, I look for negative things. When we're going down, I look for positive things. And then kind of in the middle, we get the sideways chop that inevitably will happen a large percentage of the time. As far as the videos, I'm still looking at doing the abbreviated versions for a while with a lot fewer charts. I just have to do it that way for now. And I'll probably have to end up doing that for the weekly and intermarket analysis video as well. But let's go back and talk a little bit about what happened in Friday's session. We had a gap higher open, and there were some economic reports that came out that I'll show you at least a chart of sentiment here. And we were able to get right up to R1 right away. We got a little bit above that, fell back, stayed along R1 for a period of time, a little bit above, a little bit below. And then we were able to go up all the way to R2, break slightly above that, and we closed just slightly off the high. So it was pretty positive, and we're seeing a real shift right now in the overall tone of the market. There's all these headwinds, as I mentioned. We have inflation. We have, are we in a recession? Aren't we, based on what the definition is? Well, the market likes to climb a wall of worry. And also, as I said, pretty much all of our indicators are looking positive right now. And that can be a little bit scary because when we were going down and everything looked negative, that's about the time when we hit the bottom. When we're really going up and everything is pointing to higher prices, well, we just want to be aware of that, at least in the short term. So looking at the next chart, this is the daily chart where we can see a real pickup in volume. So that's kind of nice. We had an up day. Some folks are starting to go, wait a minute, the market's going up. It's not tanking like we thought it would. Now, it could do that into the future or as we go into the dog days of August. But at least for right now, we're seeing a really good bounce. A lot of folks, and even we, have to be careful. Is this just a bounce before we get set to go lower? We have a lot of evidence to suggest that no, that's not the case. We're seeing the smart money rotating back into growth, and they're the ones that ultimately drive the markets up or down. But looking at the daily chart, we were able to break above the pivot. Now, these pivots, you'll notice over on the right-hand side, they will redraw again for August. And it's kind of interesting where we see this intermediate term support that's still above where we're at right now. We'll notice how R1 is right at about the same level. It's kind of interesting how mathematically these things tend to work out. That's some pretty big overhead resistance at about 42.73. We're at 41.30 right now. So we still have a ways to go before that will happen, but that's just something to be aware of. And markets usually just don't go straight up or straight down. Usually when they do, then we see a counter move pretty quick. But we just want to be aware of this overhead resistance of where we're at if we continue to go up. We also have some other resistance back in this conglomeration that we set back in June, where we were just chopping up and down and not really doing much before we got set to go lower. We still have not exceeded those highs. On the other hand, we have filled both of these gaps now that had been some pretty significant resistance. Well, the market really didn't treat that as resistance. It was able to break through to the upside. So things are looking a lot better. The charts are looking healthy, and we're seeing a lot of things under the surface really starting to improve. And I have to make this chart bigger. This is the closing values for value on the left, which large cap, they were up 0.75. Well, you can see growth really outperformed, being up over 2%, and pretty much across the board with the mid caps. And they were a little bit down with the small caps. We didn't see a lot of strength in small caps in Friday's session, but we did in the large cap and even into the mid caps. We did get one report that came out that showed sentiment. It bumped up just a little bit, but it's still a very, very low reading. And we're still seeing a real separation between the treasury yield of the 2-year, which is the red line, and then the blue line down here. There's a real wide gap, and that's what is measured down below right here. Are we going to see people start to get a little happier? We're seeing gas come down a little bit. We're seeing the scenario starting to play out that the market thinks that maybe inflation has topped and it's starting to come back down. But again, as I said in yesterday's video, we've been spooked by that before. But if people start to see their everyday lives start to improve, this blue line should start to go up. We're also seeing interest rates kind of more in a trend down. So we might start to see this red line start to come down, and that would bring this more into alignment with each other. This is an Isabel Net chart. This just shows the history of what's happened since last March when the Fed started to increase interest rates, where we had the first one back in March at 25 basis points. And this is put out by Goldman Sachs. Then we had a 50, then a 75. And then this past week, we had another 75. This is what Goldman Sachs thinks will happen right here, going into the fall and into the rest of the year. Now, nobody knows this for sure. We can just guess. We watch the Fed Watch tool to see what's going on, and this can change quickly from time to time. And they see it topping out at about 3.25% to maybe 3.5%, and then eventually starting to top off at that point. So again, this is just a forecast and it can change at any given time. This other chart, which I also have to make a little bigger, this is an indicator that I don't measure. I haven't found a real use for this. This is the percent of stocks at their 20-day high. You could go back to using a 20-period moving average, but I rate this more as 20 trading days. But the thing that we're seeing here up on the top is the S&P 500, and we're still in a downtrend overall, but we're showing some improvement. Down here, this is a Brett thrust. And when we really spiked up, we saw 42% of those stocks at a high based on a 20-period moving average. And then it made a lower high. And they're bringing out in this chart that says at a minimum, we want to see this surge over 50%, as is common in the early innings, there's a baseball term, of a new bull market. Also curious to us that this was better than a week ago yesterday. Now, to us, this is not necessarily surprising. When we saw this threat of 42%, that's when we really started to see a shift from the value back into the growth. Even though we weren't seeing that based on price, we were starting to see that with some of our ratios that we're looking at back and forth. So this is a little bit concerning because we're making a lower high right here. But this chart is also a couple days out of date now. This was generated on the 27th of March. My goodness. Okay, gotta love these take one videos. The 27th of July, as we were marching higher the last 2 days. All right. Then we had the active asset managers. They came out with their survey. It's starting to show some improvement. We're getting back up to a more neutral reading. We're at 47 now. And generally, between 40 to 60 or so is more of the neutral area. When we get above 60, that means they're a lot more positive at that point. And then we want to see, are they going to get to an extreme positive reading? But we're a long way away from that right now. This is another chart just showing the prediction of the probability of a recession. Well, we're in a recession now, according to the textbook term, and then there'll be modifications to that over a period of time. The one problem that we're having right now is to know when a recession hits, you really only know for sure in hindsight. Well, we need to know what's going on right now. And based on GDP, based on where it's at right now, I'm going with the definition of 2 down quarters in a row. And that's what we're seeing right now. So according to what I think, we are in a recession. But at the same time, does it really matter? We're watching the charts. We're looking at what's going on, and some positive things are happening, even though the headline is saying, oh, we're in a recession. But there's some people that are saying we're not in a recession because they're trying to change the definition. All right, let's go in and look at some of our scenarios. This is the 200 simple moving average, where we had pretty extreme negative reading and we continue to bounce up out of that. Now we drop back and look at the 50 period moving average, where we're bouncing up based on the mid caps and as well as the small caps. And then the S&P 500 is also bouncing up as well. I kind of have these in the wrong order this time. We're still working off of this spike of the 5-period equity put call ratio, where we're coming back down. And as prices go up, the equity put, I don't know why I call this the VIX. The equity put call ratio is coming down as well. And the VIX is coming down too. In fact, it's really dropping. That's why I haven't included any charts in these updates. Here's our sector rotation, where the Qs had a little trouble. We didn't see a lot of strength on a relative basis with the Qs or with the NASDAQ in Friday's session, but they're still holding up, and the moving average is starting to go up. That's positive, and price is above the moving average. We're seeing a real nice bounce from discretionary right now, and the moving average is starting to go up. And then the ratio between growth and value with the large caps, we're above the moving average, and the moving average is going up as well. Now that we're getting some distance behind us, we can read a little bit more into what the moving average is actually doing, because we can look back and go, oh, it's starting to slope up or it's starting to slope down. Here's the other chart showing the large, mid, and small caps, where we are performing pretty well with the large caps, and that's what we focus on because we deal with the S&P 500. We were pretty much flat, but still positive with the mid caps and up slightly with the small caps. Here's our intermediate term rainbow, where we're coming up to the upper side of the rainbow now. Can we break above that? And the longer we stay above these moving averages, we'll start to see this rainbow roll over and look more positive the way it did back in 2021 in there. So we just keep an eye on this. Plus, it kind of looks cool. Anyway, here's the longer term rainbow. If we could really get above these moving averages, that would turn things much more positive. We've got a long ways to go in order to do that. But it would be nice if the market could get back to where we're seeing all these moving averages separated and all moving higher. Well, we're starting to come back up into that rainbow now. Then looking at some correlations, we have the S&P going in one direction, where the 2-year yield is now going in the opposite direction, which means down. Looking at the S&P to the 10-year correlation, they're also going in opposite directions, So we're starting to see that scenario where bonds and stocks are, and with bonds based on price, are starting to go in the same, excuse me, in the same direction. Then we're also seeing a little bit of weakness in the dollar right now, which should not be surprising. If the dollar is coming down, that's helping stocks to go higher, but they have a inverse correlation right now. And then here's the condition of our trend where we've crossed above the moving average. So if you're a little bit more aggressive with the ADX, you might already figure that we are in an uptrend with the green line on top, where if you're more conservative with this indicator, you'll want to wait till we get back above 20. Then the next chart, this was a little bit of a concern in yesterday's video, but it's turning back up. So it's kind of confirming the upward movement now. This is the Swinland trading oscillator, where it finally is showing some improvement based on price and volume. The 20 period rate of change, that's just one of the indicators showing that we're getting a little topsy. We have the Stochc RSI, the stochastics, the Williams percent R, a lot of the shorter term moving or indicators that we use, they're pretty extreme positive right now. And we even have a few of the intermediate term indicators looking rather extreme as well, but they could still go higher. And these indicators can stay extreme for a long period of time. We're back above the 100 period simple moving average. We have not seen that. Well, my goodness. We broke above it slightly back in March, but this is the first time we've been above it since that time. And we were able to get above both the exponential and simple moving averages with the 100. Here's our moving average tree showing a lot of improvement, and some of these slower, I shouldn't say that, lower moving averages, which means they move faster, they are starting to turn back up. So that is showing some more positive action based on price and looking at our moving averages. We didn't get a real bump on Friday from the small caps, but we did get one earlier in the week. And now we're starting to see follow through price movement. And I called this green yesterday. I don't know why I did that. It's blue. All right. I know my colors, but I tend to say the wrong thing at times as I'm concentrating on the charts. But we are seeing a real improvement with the S&P 500, but the small caps didn't really perform as well. Here's our Fibonacci retracement where we're getting above this level now. We were able to break above that. We still have this other resistance from where we were back in late spring, early summer. And then we have what could be more significant resistance just above the 4,200 level at about 4,213 or so. The 2-year treasury yield, it is coming down overall. So the spike still looks to be valid as this continues to fall. But this isn't as big of a signal because it's usually short to intermediate term. When we look at this, this is the big one where we're still seeing the staples really decline on the ratio. So this is looking more and more like a valid spike. But remember, back in late spring, we saw this really start to go down too. The S&P really started to go up only to stall out and then come back down. So we still want to be careful with all of this. There's still a lot of negative things out there. They're still looking at lowering earnings per share and earnings for individual companies. And that's ultimately what drives price. So we can't just take this for granted and say, oh, we're going to the moon now. We have to have a healthy respect for what's going on. Then bonds seem to be improving too, where they came down to the COVID low, set a bit of a base, and are now starting to go up based on price. So that's showing some improvement. And we're seeing an inverse correlation between the tech sector, which is growth, and the 10-year yield, where the yields have been coming down as the tech sector has been going up. Then this is the last chart where we're just showing an overall decrease in the yields right now, even though we're in a high inflationary environment, even though we're in a recession. But we did turn up a little bit with yields on Friday, but overall, you can see how we've been going lower with the longer term maturities. So have a very good weekend. I'll do what I can with the weekly and intermarket analysis video, and I'll look to prepare the next video after Monday's session.